This week we're covering Chapter 14, which deals with partnership taxation, and we'll be drawing upon a lot of what we learned in previous chapters, especially the terminology and some income recognition concepts for tax purposes. So partnerships generally form to leverage either the assets of more than one person or the skills or experiences of more than one person, or a combination of the two. And so, generally, when a partnership forms, it recognizes no gain or loss. There is an outside basis, and this is generally the basis of the partnership interest in the hands of the partner. An inside basis is a partner's share of the basis from the perspective of the partnership. And they start out being the same. In this text, we'll assume that they're the same. There are occasions where they may be different. But for our purposes, we'll assume that inside and outside bases are largely the same. So when we talk about the basis in, basis out concept, the beginning basis of the partnership is just usually the basis of the contributed assets. So if someone contributes a building with a basis of $200,000 and a fair market value of $250,000, then it's that $200,000 basis value that is transferred in and to the partnership. So the partner essentially steps into the shoes of the partner, continues any depreciation schedule that was begun by the contributing partner, assumes the same life as a contributing partner held in the asset, and of course assumes the same basis. As I said, the holding periods generally are the same. We know that Section 1231 are business assets and capital assets as well. These assets, again, have the same holding period as in the hands of the contributing partner. If a partner contributes ordinary assets, such as inventory or accounts receivable, then that would be different. Then the holding period would begin at the date of contribution. Partner can contribute services to gain an interest in a partnership. However, the partner providing the services in exchange generally recognizes ordinary income, and this income is recognized to the extent of the fair market value of the partnership interest. Also, any liabilities assumed by the partnership, any release of liability by the contributing partner is treated as a reduction or an adjustment to basis. So if I contribute a building, but the partner that still has a mortgage debt on it, and the partnership are going to assume that debt, then I'm relieved of some of that debt, and that would reduce my basis. I mentioned before, ordinary income items are generally contributed to a partnership where the date of contribution is the date that is considered used in adjusting the any value in the assets contributed, like accounts receivable or inventory. So a partner gets credit then for some of the income, their proportionate share of the income. And then we'll also be discussing some separately stated items that the partners will also get on what we call Schedule K1. We'll talk more about that shortly. And then there are guaranteed payments. These are payments made to partners that don't even consider the partnership income, but they are income to the partners that they must report on their Form 1040. Depreciation follows the same rules as under any business. What's a little bit unique about the partnership is that Section 179 expenses of the partnership assets, those are sent separately, as separately stated items down on K1 to the individual partners. And also the partners generally cannot exclude the income from health insurance premiums paid by the partnership. These would be treated as income by the partner, very similar to guaranteed payments. I mentioned earlier that there are many income and expense items that are treated as ordinary income. Others are treated separately stated. In Table 14-1 in the text expands on these. Some of the more commonly separately stated items. Now what we mean by separately stated is we mean these are sent down on the Schedule K1 as items that are not included in ordinary income, such as rental income, interest and dividend, capital gains and losses, and as I said earlier, Section 179 expensing of partnership assets. This is the report I mentioned earlier, the Schedule K1. where it's just kind of a breakdown of the partner's individual share of the ordinary income and then the separately stated income. And the amounts that are reported on K1 correspond to the Schedule K of Form 1065. And Form 1065 is an information return that is sent on behalf of the partnership or by the partnership to the IRS. So while the partnership is a pass-through and it itself does not pay taxes, it must submit an information return to the IRS, and then the income is passed down on K1 and must be reported by all the partners on their individual 1040s. So there is self-employment income. Since a partner is not an employee of the partnership, the income from the partnership is considered self-employment income. So these items, ordinary income from K1, you would add to that any guaranteed payments, deduct any 1231 gain included in ordinary income, as well as deduction of any 179 expensing on K1. So here's kind of a calculation that kind of expands on how bases are adjusted for partners. So the outside basis, again, this is calculated for each partner, is first you start with what's contributed to the partnership. You'll add to that the fair market value of any services that are rendered, add any basis of cash or property contributions, add any share of the partnership ordinary income that was attributed to the partner. That increases the partner's basis, as do any separately stated items. Any share of the partnership liabilities that are assumed or where the partner would bear the risk of the liabilities is added to their basis. And then anything taken out of the partnership, cash or property, but not below zero, is a reduction of the basis of the partnership, to the partnership, as well as a share of any losses. So if the partnership doesn't do very well and they lose money, then that would count as a reduction against the individual partner's basis in the partnership. The partner's share of any separately stated loss items and expense items like Section 179 would be a reduction in basis, as would any release of partnership liabilities would reduce the basis of the partner. So all these factors then go into calculating the basis of the partnership, the partner's interest in the partnership, And so that helps then to determine, for example, on distribution, how much that's distributed is considered capital gain, how much is considered a return of capital, how much is considered income. We need to know and keep updating that bottom line basis value for each partner's interest. So a partner recognizes no gain or loss on a non-liquidating distribution. So, for example, if a partner receives property from the partnership, the partner would recognize no gain as long as it's a non-liquidating distribution. There are occasions when gain is recognized on distributions. For example, when money or marketable securities are distributed in excess of the partner's basis. And then any current distribution of pre-contribution gains. And what this means is if a partner contributes an asset to a partnership and its fair market value is greater than its basis, it will only contribute the partner at basis, and its capital account, for example, will only be increased by the basis. And then this pre-contribution gain is just not recognized. However, if in certain cases, in certain instances, if property is distributed, for example, within 7 years to another partner, if this same property with this built-in gain, this pre-contribution gain, is later sold or distributed to one of the partners of the partnership within 7 years, then that would mean that the contributing partner would have to pay taxes on that pre-contribution gain. Otherwise, they would not. So these built-in gains usually are of no tax effect unless, of course, as we said there, they take the form of money or marketable securities, or they are contributed assets with a built-in gain that are later distributed to other partners within 7 years of the original contribution. This is that rule I mentioned regarding a situation where a partner contributes appreciated property. In other words, had they sold the property rather than contributed it, they would have made a gain and paid capital gains tax. But by contributing it to the partnership, they don't have to pay capital gains tax unless within 7 years the partnership distributes the same property to another partner. And then the basis of distributed property, typically the partner steps into the shoes of the partnership, so whatever the basis was of the property in the hands of the partnership becomes the basis of the property in the hands of the partner after distribution. Now liquidation, of course, liquidating or eliminating a partnership interest, very similar, rules are very similar to current distributions. Again, if a partner receives more money than their basis in the partnership, that would result in a capital gain. Now, loss can be recognized when the amount received in liquidation is less than the partner's outside basis, and only money receivables and these ordinary assets are received. A sale of a partnership treated as a sale of a capital asset. So if a partner sells their interest in the partnership, any amount they receive in excess of the basis would be considered a capital gain. And then, of course, individual partners would report all of this activity on Form 1040 on Schedule D as we have in the past. In the next video, I'll be going through some of the problems in Chapter 14.